What do you think about this take from Mike Wilson, the idea that there could be no cuts this year? And in your mind, does that mean that the economy can keep moving forward in a positive direction?
Yeah, at the end of last year, we had said we were bullish on the markets and said it's not reliant on these 6 to 7 cuts that the market got excited the Fed was going to pivot. We said, hey, if the Fed's not cutting, it's because the economy is doing quite well. And we just talked about commodity prices. There's certainly geopolitical tension, but I agree that a lot of the growth in some of the things like oil is actually a stronger economy fueling demand. And so you look at what's holding up well, what's not participated in mega cap tech, but there's parts of the equity markets that are benefiting from a stronger economy that haven't participated. That's, I think, the place to look for within equities.
All right, so you're saying it's not dependent on a rate cut, but you are keeping a close eye on CPI, especially when it comes to the equity market. So I'm looking at core CPI. Last month, the number was 3.8%. The estimate is 3.7% for this upcoming report tomorrow. How important is it for that to be in line or slightly lower when we talk about the performance of equities going forward?
Yeah, I mean, it's going to be the lowest CPI print in a number of years. And I think actually the reality, we've talked with you before, Frank, about our own alternative measures of inflation using real-time data on rent that makes inflation even well below 2% when you use things like apartment list rent instead of BLS shelter. So the trend is their friend, both for the equities and for the CPI. We think, some of the cooler CPI could be helpful for more gains in stocks. Certainly people are worried about that inflation risk coming up, but we think the trend is going in the right direction for inflation.
While we're looking at inflation, we were just hitting on it, commodity prices rising. That's a big part of the inflation story. And then that also impacts certain sectors. Obviously, the materials sector seems to be getting a boost from this rise in commodity prices. Does that hurt other sectors as well? Because we've seen over the last month, materials and industrials are up double digits. But if we continue to see that rise in commodities, does that hurt the industrial sector? Does that continue to put pressure on the real estate sector?
What we just talking about, what sectors fit well in portfolios. Commodities have this very useful hedge to stocks. I've been talking more and more about how bonds are not hedging stocks the way they used to. Say, if there's a risk to the equity market, is it 10-year at 440 today? Does that go to 5? Well, what would drive that? It's commodity prices going higher. It's materials going higher. So from a whole portfolio allocation perspective, you say, like, what can hedge your downside risk? I think the dollar is one of those risks that could hedge it. A strong dollar would hurt U.S. profits. I think rising commodity prices would be a hurt to profit. So I think, that the energy sector, the material sectors are useful for that.